Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. In its latest meeting in early November, the US Federal Open Market Committee (FOMC) raised its policy rates by a 75 basis points increment for the fourth consecutive time. This tightening cycle, which began in March this year, has so far seen the policy rate rise by 375 basis points, taking the upper bound of the US Fed funds target rate to 4%, the highest level since 2008. This, of course, was necessary as inflation remained rampant owing to a range of reasons which are widely discussed. However, going into the latest Fed meeting, expectations that the Fed would eventually turn more dovish at the margin were budding. In this episode of the podcast, we assess the extent to which the FOMC statement and the press conference by Chair Powell managed to appease and surprise markets. We also discuss what the policy outlook means for financial markets. Let's first look at what came out of the latest FOMC meeting. To start with, the rate increase was 0.75 of a percentage point, not only the same as the previous three times, but also was in line with expectations. Then came the press release. The wording of the statement was identical to the release from 6 weeks ago. However, the statement that in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments sounded dovish. After all, it was Fed acknowledging that they are not going to ignore everything else in their attempt to fight inflation. Also, explicit mentions of smaller increments to the policy rate in the meetings ahead were welcomed. Markets reacted quite positively to these developments, but this did not last for long. The press conference showed the hawkish face of the Fed. As Fed Chair Jerome Powell delivered his prepared remarks and answered questions from the press, the market's mood changed as the chair himself indicated that his estimate of the peak rate has risen since the last meeting. Given that the FOMC had not provided its updated economic and policy rate projections in this meeting, markets were left to guess by how much the peak rate has risen in the minds of the policymakers. This has induced volatility back into rates and equity markets. So, markets were left to grapple with slower for longer yet higher for longer narrative, which if holds can be a double-edged sword for financial markets. On the one hand, a more gradual ascent for rates might mean that the chances of a policy error are reduced at the margin and therefore lower market volatility. On the other hand, whatever the terminal rate ends up being, FOMC will hold it there until inflation comes down to target. This could mean a substantial slowdown in the economy, a squeeze on corporate profitability, and eventual increases in bankruptcies and defaults. Yet, taking a step back, we wonder if the slower for longer yet higher for longer thesis should hold. We believe that inflation is key here. Should inflation start to cool down rapidly, we believe that there is little incentive for the Fed to keep rates at a very elevated level for exceptionally long, especially at a time when the growth picture appears to be softening. Regarding inflation, as we have argued, strong disinflation and outright deflation for certain sectors is the key risk for markets next year. While the actual consumer price inflation data remains elevated, some of the high-frequency indicators of prices have started to roll over quite aggressively. Falling rents across the US, slowing wage growth, well-anchored inflation expectations of consumers, falling inflation expectations of businesses, a sharp plunge in commodity prices, faltering global shipping rates, etc., are all likely to feed into slowing consumer prices over the next few months. For investors, what Fed and other central banks will do in the future matters more than what they are presently doing. Thinking 3, 6, and 12 months out, should inflation cool as we expect, there is little incentive for the Fed to keep its hawkish stance. After all, as some famous personality once said, when the facts change, I change my mind. We think this also applies to the FOMC. From an investment strategy viewpoint, we think patiently waiting for a central bank pivot is what investors should be doing now. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.